All right. Welcome everybody to Midas Investing Live. Hope you all have had a good couple weeks. Hoping to get to another live show with only 2 weeks in between. Try to keep no more than 2 weeks. I know we kind of went like a month or so before the last one, but here we are. We made it. Sorry for anybody who was waiting on the delay, namely Dan there in the chat. Hey Dan. Figured it's better to just pump the time up on YouTube rather than just be late and have people wondering where I was at exactly. But yeah, makes it easy to do that stuff. Have I ever played Scrabble? Actually, I never actually have. I'm familiar with it. I've seen people play it and whatnot, but I don't think I've ever actually been part of a game of Scrabble myself. Play lots of other board games and stuff like that, but never quite got around to it. Why? What's up with you? Were you headed for a Scrabble party or something? But yeah. Anyway, so I'm very excited to get into some stuff we're going to talk about here today. I think it'll be pretty interesting for some of you. First off, I will comment on, as we typically do, or actually no, first before we even get to any of that, we're going to do a little bit of chilling for myself and for my platform. So of course, if you are just finding us, please give us a like. Please subscribe to the channel if you're not already. Hit the notification bell and all of that. And of course, join the free Discord. The link is in the chat, as well as the is also in the description below. And also, I would point out that you can support the channel through the PayPal link that you can find on my main page here, as well as in the description. As well as I have a Patreon link that's now in the description as well. So if you guys are interested in perhaps subscribing to that, that's a thing now. Just getting going partially because we finally managed to get a couple people who are interested in the valuation dashboard, and so I put that together, which it is $5 a month for valuation board access, which of course I also have then a $3 a month just kind of supporting the level if people are interested in that. So if you want to join the Patreon, feel free to do so. Also feel free to send me, like I said, donations via PayPal. And of course, if you wish to perhaps commission my time in some other ways, like potentially consulting or something like that, we can arrange for ways in which there is a give and take. It doesn't have to necessarily be a donation, but I haven't really arranged that many features on here yet. So it's pretty bare, pretty simplistic, mostly just put it together as a means of serving specific people who've asked for specific things. And in regards to that, we'll talk about the valuation dashboard, so you kind of know what I'm talking about if you are first time being here and don't know exactly what I mean by access to the valuation dashboard. I have a dashboard here where on this third page there is a list of all the companies that I have fully modeled out, their revenues and costs and their valuations for, which is all these companies right here, a lot of which are companies that I have videos for on YouTube. So if you're looking at all these companies that I've valued on all these videos here, they all are on the dashboard, as well as there's a decent handful of companies that don't have videos as well. Like for example, Pink Premier Inc. There's also Parex Resources, and a few of them. Disney, I don't believe I made a video for Disney as well. So there is a few companies on here that you get essentially more information than is in the videos, or you get any information whatsoever, I should say. And it is not just this page here where you can see my values as it is listed here, as well as the expected returns that I have listed here, the terminal multiple that's being used in the valuation, so it gives you a sense of how conservative I'm being, but also the distribution in the current percentile in the valuation distribution that I create. You might be saying, well, what do you mean by that? Well, there is also these side pages where you can take a look at all the financials up to 10 years for the companies as I put them together. You can use this drop down menu to have it load another company from that list as you would like to select. It takes a second or two, possibly up to a minute to load the information, partially because Google is only as fast as it can be. But there you go, boom, it pops up. And then on this page next to that, there is the DCF, where it gives you a summary of the valuation assumptions in there. But then you can also scroll down to see the distribution of value. This is what I was talking about, where I've essentially put together out of 1,000 outcomes using probabilities associated with the assumptions I put in here. How likely do I think it is that today's fair value is any of these given numbers? And then there's also expected returns associated with that. But scrolling down, you can see all the assumptions that goes into it, the revenue assumptions, as well as the operating margin assumptions, capital expenditure assumptions, as well as the terminal multiple assumptions and terminal free cash flow assumptions. So that's basically what the offer is. For $5 a month, you can see all the companies as well as all the assumptions that goes into those valuations. And then there's also a few little added bits on there as well, like this market dashboard where it gives you an overview of what's going on in major capital markets, including bond markets, commodity markets, and of course equity markets of large, mid, and small cap sectors. And then there's also a macro section with a bunch of economic information that also gets updated semi-regularly, though this page is a little bit more of a work in progress. I'm still looking to update that and fix a few parts of that, some issues with it still existing as it currently stands. So in a sense, you could say that if you pay the $5 a month, you're in a sense beta testing for $5 a month, but nonetheless, you can get access to all that for only $5 a month. All right, enough shilling for myself, but I definitely got to do that from time to time here on the channel. I'll get back to Dan's comment there. What was he saying about Scrabble? He thinks he'll like to dedicate himself to Scrabble maybe one day to reach mastery. Interesting. That's definitely a fun one to do. I used to be pretty fond of playing chess with friends back in the day. You could say that's sort of a similar thing for me. An old man hobby. Yeah. Very nice. Yeah. Oh, okay. I see you there. You currently play some chess as well. Pretty fun. Yeah, juicy. Yeah, and by the way, there are people in the chat that have experience with the dashboard, so you can ask them about their takes on that as well. All right, so on that note, we will go back to the main portfolio page and we'll comment on some of the changes that have happened in the portfolio over the last couple weeks. Namely, we do have 2 new companies in the portfolio, and we also got rid of a company in the portfolio. So we have added Mastercraft MCFT, which is currently only about 1% of our portfolio, where we have a sizing minimum of up to 1.9%. So we expect to potentially double the current position size up to that size. And then we could have it go up to close to 4%. So between kind of 2 and 4% is what I'm guiding for in the portfolio range. And it's currently at 1%. I have not built a full model for Mastercraft, not yet anyways. That's definitely a potential model that I'll be making here in the near future. Well, I say potential, I'll definitely be able to build a model, but where the potential is I think there's definitely some potential for me to make a video out of it. So I'll make the model, see how I feel about it, and potentially that could be the next valuation video that comes out. Like I said, I haven't even started on that, so I'm not 100% sure when that is going to happen. But at the same time, it'll probably happen sometime soon. And then also, we did add Click Digital, CLIQ, to the portfolio, which was a company we had a pretty vibrant discussion on at our last live show. Which, by the way, I did want to kind of comment on that because there was some homework that I had to do after the stream, after one of our viewers was coming in and gave some criticisms of Click based off of expected dilution that they thought was coming based off of some filings that they had read from the German statements. And because the statements were in German, I wasn't able to really check up on that information while I was live. But I did look into all of that after the fact, and it turns out it was not actually a dilution story. And I had commented at the time that it seemed strange. Like I didn't want to call the viewer wrong, per se. I kind of wanted to be gentle about it, but at the same time, I kind of knew that what they were saying didn't really make sense. And so it seemed like it didn't really make sense to me. And turns out, yeah, it's because it wasn't really accurate. They kind of misinterpreted what they were reading. Essentially, what they were reading was about warrants that were being granted to the executives, which warrants are more like an option to buy more shares at some point in the future, which technically comes with some dilution. But they were saying that it seemed like they were getting the dilution at such a low price that it was ridiculous, which wasn't exactly the situation. So there is no real issues with that, and because of that, I did decide to take a position on it. Now, it is a highly speculative position, in my opinion. There's a really large expected return opportunity here, but also lots of risks. So it's definitely going to remain a very small portion of our portfolio. We're guiding for like 1 to 3%, including the capital appreciation, which is supposed to be, we're expecting some serious multiples in total returns when it comes to that particular position, if it's in any way like the growth case that we're seeing as having potential in it, which is why it's a speculative position. We see lots of risks in it, but we also see an incredible potential amount of reward for those risks. Now, to get to that last comment there from Dan, what is the company that we ditched from the portfolio? That would be GNL, which was one of our smallest positions at the time. Global Net Lease was a REIT that I had taken a position on only a handful of months prior. After going through a large amount of my sector screening process, after doing some screening in the REITs, that one seemed particularly interesting to me for a variety of reasons, and I had kind of jumped into it relatively quickly without building a full model based partially around the pricing dynamics that I saw in it, but also because I did kind of wanted to get a little bit of some REIT exposure, partially because of the the potential for the lowering of interest rates this year, which the way I was seeing it, was going to create a potential for a very, very large amount of multiple revision in the back half of the year. So it was a little bit of a speculative position in and of itself, and definitely more of like a shorter to midterm kind of play. And after doing some more research, I decided that the risks definitely weren't worth the squeeze. So we decided to ditch out of that one for a relatively small loss on the position. But as I said, it was basically one of our smallest positions, so it doesn't really have a huge impact on the portfolio. Decided that we would rather just clean it right out since we decided that it wasn't quite going to give the same level of potential returns for the amount of risk that it was, as say, like for example with Click. Dan, I think Mastercraft is probably one of the companies that the viewers liked the most. Maybe InMode was number 1 and Mastercraft number 2. The only position we haven't commented I still have with you is SVM. Well, yeah, I certainly have SVM. It's right here, which is also one of our smaller positions. I kind of wish that I had built up the position a little bit more, but I definitely saw potential risks with that one as well, so I wasn't trying to go very hard with it. And then obviously it moved up relatively quickly in terms of returns. We are in fact already up about 28% in returns on SVM. So unfortunately, it moved pretty quickly, and relatively fast towards more of a value with it. I still see it as having about 20% of upside to the fair value I currently have, because I think I did actually end up giving it a small boost since the video, but I actually gave it a bump down and then a boost since the video, and that bump down kind of kept me from wanting to buy more, because I was like, well, okay, maybe I might have gotten a couple things wrong, but then I kind of revised myself backwards a little bit since then. So yeah, unfortunately, I didn't build up position as much as I should have, as quickly as I should have. I was also focusing on other things, but yeah, very, very good position. I'm still very, very excited about that position. I just wish it was a little bit larger in the portfolio. Now, as for InMode, now I don't know how much you've paid attention to all the discourse in the channel. It's certainly a highly talked about company in our community, but I wouldn't necessarily say it's one of the ones that viewers like the most. They might have liked it at the time the video came out, but I feel like the sentiment has definitely shifted hard against InMode, and including in my community. There's still definitely a few of us that are very bullish on the company, but there's definitely a lot of other people, a lot of naysayers on the other end of the table there. So it's definitely not the most liked company right now. It may have been at some other points in time, but and I definitely think it will be again, because I'm still bullish on it, of course. But so we'll see about that. InMode definitely being a much larger position in our portfolio, it being number 6 in terms of the actual individual companies here. So yeah, those are the only real major changes to the portfolio as it currently stands. I did trim a little bit more Smith & Wesson in the interim after I did previously. Olga, hi, welcome. But yeah, nothing too major after the relatively large trim that I had done when I got rid of about a third of the position. So we only really just got rid of a handful of shares ever since then. Now coming down here to kind of comment on some of those returns, as I had kind of pointed out, SVM is now over 25%, which is kind of the ones that are marked green here are ones that have at least 25% in total returns, because that's kind of the point where I say it's a substantial enough return to kind of like say, all right, it's actually a winner. I don't really celebrate 5 to 10% of returns, but if I get 25% in a relatively short period of time, at that point I consider it a decent knockout of the park, so to speak. While at the same time, anything down 25% gets marked red, though obviously the only one marked red right now is my puts position, which is a hedge, so it is pretty much usually pretty permanently in that position, except for maybe a couple days here and there where it swings back to the other side. But I do have a system for trying to trade those options where I'm essentially trying to sell them when they do go back up there, and then down, and then buy more when they go down. So that's just the nature of it. Dan himself is up 35% on SVM. Very, very nice. Yeah, looks like you got a little bit of a better bottoming out on the pricing than I did, which is good. Coming down to take a look at the returns, in terms of comparing us to the S&P has continued to do very well relative to much of anybody else that is invested in things that aren't the S&P, and especially the Mag 7. So still significantly underperforming in that regard. As far as the year-to-date returns, we technically closed the gap by like 1 or 2 percentage points since like the peak levels, because the small caps actually have done relatively better in the last few days. And then we were actually underperforming the small caps there for about a month or so, and we actually caught back up with the small caps. So nice to have caught up with the small cap index on the year to date, but and obviously over the long run, we're already significantly beating the small cap index. But definitely still would like to catch up to the S&P both on the year to date and then hopefully in the long run on the total time weighted returns. So that's kind of the last comments I'll make here on the portfolio. Oh, I guess one other thing I will point out is that I do have these little side pies here where they kind of give some more characteristic details of what's going on in my portfolio, different asset types, the type of strategies as I allocate them, the size, the benchmark overlap with the S&P, commodity exposure, and foreign exposure. But I did want to kind of point out that because I have Click Digital here in the portfolio now, that is actually the only micro cap I have in my portfolio, which is this little orange slice right here, when previously I didn't have any exposure to that. Or well, actually, no, technically I think I have one other one because it's showing 2% here. What's the other one that's under 500 million? Something might have been under it and I just forgot. Oh, Mastercraft, of course. That's right. Mastercraft and Click Digital both are under 500 million, which is what I define as microcap in this particular chart right here. So beyond that, we will come over to Scott's asking how big is the MOS position. Relatively small as well, and definitely needs some more increase. We're still only at 1.1% on that. So Mastercraft, Mosaic, and Silver Corp are kind of all in the same range. And the minimum is up to 2%. So I really ought to be buying more Mosaic, but as we kind of talked about, that one was moving up pretty much as soon as I bought it too. I'm about flat on it now, so it's definitely in a better position to buy more. But considering it is a commodity company, I've been trying to be more careful with that, and I've also focused more on Mastercraft a little bit lately. And to be honest, I've been very, very distracted in the last week, so I definitely haven't really been buying it a whole ton. Mosaic, the target's too high. The top end target is very up there. There might be something wrong in the formula there, because like the minimum size makes sense, but I'm trying to remember how do I have it set in such a way that it's doing that. Let me go check something over here where that kind of whole system is put together. Interesting. I think it might have to do partially with the current momentum dynamics, because technically the targeting system does take a little bit of current momentum dynamics into account, especially on the top end of it, because especially like the top end of my ranges are kind of designed to push a little bit higher when a stock is kind of going through decent momentum under certain circumstances, because the idea is that if it's pushing upward, you maybe kind of want to not necessarily sell too quickly, because momentum can be a relatively solid factor to tilt towards on the upward end of things. So I think that's the reason why it's doing that. The pricing, I don't think that's part of it, because I have it set in that calculation not as a pricing company. Once I build a full model, I don't really set it as a pricing investment. The only things that are currently set as a pricing investment is Mastercraft and Click. Those are the only ones here that are specifically set towards that strategy, which is also, by the way, on these little side pies right here. The purple slice is any companies that are set as a pricing or a workout type strategy. So yeah, Mosaic's not actually in that grouping. I think it has to do with the current momentum dynamics. It's like the way we're looking at it. It's actually, I mean, it says that it's in a low bearish momentum according to the chart right here. I don't know. I might have to double check something on that. There might be something going wrong there. That definitely looks a little bit strange, but at the same time, it does take a few factors into account. So I have to kind of double check everything to kind of figure out what's going on there. Olga, did you ever speak how big of a position size you hold on each stock, or which size you can scale into in case of tranches? Well, I kind of talked vaguely about it. That's sort of what we're talking about a little bit right here on this chart. That's basically kind of what this chart is meant to show. The next to each one of these lines, there's kind of a second column next to each of them. So there's two columns for each company that's in a position right here. The blue or the grays or the light green shows what the actual position size is in percentage, but then the kind of beige and orange bars next to it give you a sense of where my target range is for it. The idea is I want to be in the orange range there, at least up to the minimal level, and then the top level is where I essentially am trying to guide for potentially starting to trim. It's a little bit of a loose rule. I'm definitely willing to kind of like go with it a little bit, especially on the top end of things. Like maybe I don't trim super quickly if it goes over the line. But if I'm under the line, that's what I consider to be an under allocation, and so I should be trying to go up towards that. Now, as far as like the factors that go into it, as I was kind of just talking about, there's a lot of things that kind of go into that. Specifically, I consider what strategy I've associated it with, whether it's one of my macro strategies or a pricing / workout strategy versus just a full model evaluation, which the majority of the becomes of evaluation. And then I also take into account what I call the revenue profile, both the past profile and the future profile, in terms of I bucket them into 4 different categories of whether their revenues in terms of the actual products that they sell, not just the dollars at which they sell them for, is either increasing, decreasing, has more of a cyclical nature to it, or is flat on a certain basis. Olga adds another comment, meaning in dollar values. No, I actually specifically try to avoid talking about dollar values on my channel. It's actually kind of a little bit of a personal gripe of mine with a lot of finance YouTube, where people like to, put the stock ticker in the thumbnail, and then like $50,000 or whatever, and then with a big shocked face or something like that, and then kind of like suckering people in and be like, oh yeah, I just put $50,000 into this stock, and I think it's going to go to this place. But then they don't tell you that they have like a $2-3 million portfolio or something like that, and so that kind of like it kind of skews the sense of the scale of what the position size is to their viewers. So like somebody who says, oh, this person put $50,000 in, say, Tesla, that sounds like it's a lot of money, but in the end of the day, if it's only like 1% of their portfolio, then that doesn't really tell you that much, right? That actually means that they're making a relatively small bet on it. So I like to speak pretty much only in percentages, especially when I'm talking about portfolio allocations. And then I prefer to do the same thing when it comes to returns, because people also will do the same thing with returns. They'll say, oh, I made $50,000, $100,000 on this stock, but they don't tell you how much money they put into the stock. Or the same thing with their portfolio. They're like, oh, I'm up $1 million on my portfolio, but they don't tell you that, or they tell you that their portfolio is worth $1 million, but they don't tell you that about 80,000 of it was actually just their deposits because they have potentially a high paying job. So on this channel, I pretty much only prefer to talk in percentage terms. In fact, I try not to show anything in dollar terms on my screen, although technically when I just did flip back some stuff that showed some dollar related stuff if people were looking closely. I suppose you could go back and pause if you wanted to and take a look at certain things. My portfolio is not super big, for the record. It's a relatively moderate 5-digit portfolio because I've been a student for the last 3 years and a full-time student for the last 3 years, and so I had to quit my full-time job at that point. I'm going back to full-time work here in the summer, and I can't wait to start adding more money to my portfolio. But yeah, my portfolio is not necessarily like $1 million portfolio. But at the same time, the only way you can compare yourself with somebody who does have $1 million portfolio is through percentages. So yeah, that's kind of my preferences when it comes to talking about things. It's a little bit of a pet peeve of mine when I watch finance YouTube and I see people, what I would say is manipulating their audience in terms of the actual values that they get on their portfolio. So I like to talk just in percentages. Yeah, Olga kind of adds a little detail there. I see you definitely understand the stuff I'm saying. But like you were talking specifically about potential for like tranches, and you're saying like, oh, I use 600 USD for tranches on dips, and then maybe 2,000 USD on a single stock, which is fine. But you could also talk in percentages, right? You could say, say if like, I don't know what your portfolio size is, but let's just say the $2,000 USD is like 5% of your portfolio. Well, then what you could say is you could also just say, well, I like to do a tranche of about 1.5%, up to potentially about 5%, right? You could kind of use the same thing. And so what I would say in terms of like thinking about that, whenever I start a new position, I generally like to put at least 1% in. It doesn't always work out that way. Sometimes I do a little bit less than that, but generally I like to put at least 1% in, so that it is at least kind of always going to be initially a decent portion of the portfolio. Sometimes I only put 0.5% in. initially. But as I've shown here, the minimal sizes are often at least around 1% as well, potentially around 2%. So that means it might go from 0.5% to 1% up to around 2% at a relatively quick pace, because I might be trying to buy into it before it moves up too quickly. But if I think it's the kind of stock that has a potential to kind of be a laggard for a period of time, and has a lot of negativity around it, well, then I might be kind of slow in my process of building up to that minimal level. But the point is generally I try to put at least about 1% of my portfolio into something initially, and then I try to kind of build up to that minimal level at a relatively quick pace. And then once I'm at that minimal level, I'll start to be much more cautious about adding more to it. Though I'm generally willing to add potentially up to even halfway through the orange bar, and while still doing stuff like that. A decent example of this was actually only like 2 weeks ago, when I actually did purchase a couple shares of FG, even though it's my biggest position, and it was actually kind of above the middle of my orange target range. But that's partially because I was looking at it as being potentially a decent bargain relative to the peak levels that it had right here. It's still very, very high up relative to the run up that it had done through the last year. But I was watching this downward move and was thinking, man, I feel like my favorite company, because FG is my favorite company right now, and has been for a long time, not in terms of necessarily the value that you get if you buy it here at this price today, but in terms of liking the growth prospects for the company, as well as feeling comfortable holding the company. Like, I sleep super well holding FG. So I was looking at this and being like, man, I think I ought to be buying more. And well, it was a pretty good, well-timed buy as it has turned out since then, in the short run, of course. We're looking much more towards the long term, when I definitely think it could get back up to more like $50 range or even higher, as the valuation starts to grow. It's worth noting that my current expected value for FG is just under $45. So I see about 13-14% upside currently and 11% expected returns, which is, nothing super amazing to write home about. But as I said, it's also bounced up from at about $35, $36, which is around where I was making those purchases. So up to $39 from there, it was already a decent bit better from that perspective. All right, so let's see, what's the next thing I kind of wanted to talk about here today. I definitely need to make a note to double check on the mosaic allocations issue. Okay, so I am working on a few things behind the scenes. As I kind of already mentioned, I'm definitely heavily considering doing a video on Mastercraft, but it might be a couple of weeks before I can actually get that one out there. But I have been working on a couple other videos that are not valuation specific videos. I don't really do a ton of those. The last time I did a video like that was my annual report video, which, by the way, not the crazy amount of views, but if you would like a very, very simple overview of annual reports and their different sections and like the usefulness of them, I did make a video on that not too long ago. But I'm planning to do a video particularly on the returns of the companies that I've made videos on. So ever since I started using the DCF template with the valuation distributions, the first company I did valuation on in that regard was ATKR, Atcore, which is a pretty popular company in our community, definitely, even though I didn't take a position myself. But the point is all the companies since then, including Meta, Netflix, Interfor, FG themselves, and all the companies you see here, have all done varying levels of decent returns, or some of them not the greatest of returns. And so I went back through and I took a look at what was the valuation that I said it was worth in that video, and then compared that to where the valuation is on the dashboard now, because it is worth noting that I have upgraded and downgraded pretty much all of them in various ways. I would say probably more have gotten upgrades than downgrades over time, but a few of them are kind of in the same area as well. And so I've definitely been looking to kind of do a little bit of a review of my own work, see like how well have things done, how well would things have done for various people if maybe they had gone and bought them at the time of the video, and then comparing also the distribution of the outcome. So what was the upper range and the lower range that I had said in that video in terms of the quartiles, and then compare that to the record that they've had in the market since then. So like what has the stock done? What is the highs and the lows of the stock been since I put the videos out, and kind of compare that. So like if the way I'm thinking about it is like I want to compare the lower quartile of the valuation that I had given to potentially the low of the stock in that time frame, and then compare the upper quartile to the high of the stock during that time frame. And then likewise, we'll just see how much the valuation has changed over the year, like I said, compared to where I have it currently. And then, where's the stock today? And then we'll also definitely talk about which ones did I buy, which ones did I sell, which ones did I continue to hold if I had them in my portfolio previously, and all that good stuff. So I'm planning to put a video out on that at some point soon. I've been kind of putting together this little sheet in the background that include a bunch of things related to that, but I still have a lot of work to do on that. But that's a video I'm hoping to do at some point soon. Because definitely there's people who have sung my praises for a variety of positions. Like I see people talking about AAP in the chat, very, very, very much. And thank you very much for all your comments in that regard. And, definitely that's one that kind of makes me want to think about it in particular, considering AAP was a position that I was down over 25% on before now being up about 34% in total returns. So it's a good example of just how volatile some of the moves have been and some of the names we've called. There's definitely been people who've been very, very happy to have ridden the FG wave with us, being well over 100% at this point. And then I don't necessarily think there's a lot of people that paid as close attention to FNF, which is another major position of mine, which is the parent company to FG, but they themselves have done incredibly well in that time frame as well. In mode, definitely, as we already commented on, is one that was loved and is not loved quite as much these days as much anymore. So that's something to comment on. And Dan had already commented on SVM, of course. But of course, there are companies that aren't in my portfolio, companies that I still made videos on that have done particularly well or particularly not so well based on that. I do think it's worth paying attention to whether or not I bought and sold it or sold it, because obviously if I didn't buy it and then it didn't do that great, but I still said the valuation was pretty decent, then that kind of says something that maybe there was something in the back of my mind that kept me from buying it, where I kind of knew maybe it was riskier than it was. Not necessarily the greatest of examples come to mind for that. In fact, really, there's plenty of companies that I didn't buy that have done well. For example, companies like Ulta, companies like Home Depot and LPX in particular. I made videos on those, and both came about this close to having me pull the trigger on buying them. And both of those points where I was about that close were actually relative lows in the stock, and then have performed relatively well since those lows. So it's ones where it's like, man, I should have at least gotten in a little bit because they had done incredibly well. Then there's examples like Meta where they did do really well. I did continue to hold them because it was already in my portfolio. But I also sold significantly on the stock, and it continued to do extraordinarily well despite the fact that I sold it. Then, of course, there is one particular disappointment, I would call it. Disappointment's a strong word because it is what it is if you don't buy into things. But there is SMCI in particular is one company that is no longer on the dashboard because I have removed some companies from the dashboard here, but is a company that I did make a video on, did make a full model for, and I did not buy. In fact, I said it was overvalued at the time, and it has done incredibly well since that time frame here. This one right here, 737 views 11 months ago. Let's go take a look at that, because when I made the video on it, it was, well, like I said, it was 11 months ago. So if you what's it, we're here at the midpoint of March, so that makes it kind of like April. Yeah, it was like $90 or something like that when I made the video, and it is now $972. So there's a company that I made a video on that has 10x in like a 1 year time frame, and I missed it, 100% missed it. And I also said it was overvalued. Now, I definitely still think it's overvalued, of course. That doesn't really change my feelings or my thoughts on that, but at the same time, it's one of these things where, not every video I made has been able to call the market. Now, of course, we're also just talking about market movements over the course of 1 year, or even less so for videos that came out much more recently. So, of course, in the long run, maybe I'm incredibly right. Maybe I'm very right in the long run, and we'll find out. But it's one of these things where, in the short run, that drives how a lot of people might think of how successful your content is in terms of providing value or something like that. So there's obviously a little bit of give and take when it comes to thinking about long run returns versus the success on YouTube. But nonetheless, we're going to go over my record in terms of the videos on YouTube. Now, the other video that I've been thinking about and working on is a video related to a lot of the sector pricings that I had done a few months ago. I did a whole overview of companies within both the large cap and small caps, segmented by sectors through various indices. And then I did pricing analyses for each of the sectors. And my goal is to actually repeat that process essentially every quarter. Because the pricing analysis, as I do it, is kind of closer to a very simple rudimentary way in which like quant funds work, where they take essentially all of the fundamental information they can get, plus lots of non-fundamental information as well, and then use statistics to essentially try to determine which stocks to buy or short in an overall portfolio. Now, I'm not looking to short companies, but the point is I am trying to identify potential mispricings in the market, and then also see if the valuation backs that up, because in my opinion, that kind of adds like as a second factor that can work in your favor, beyond just pure cash flow valuation, where companies people might start to recognize, these pricing dynamics are wrong. Let's start to push the stock up. And so it's something I like to pay attention to as well. It's, I think, a very, very good way to sift through companies to try to find hidden gems. And it's actually worked out pretty well for us in that time frame. For example, SVM is a company that we identified using this method. So it's something I'm looking to do potentially every quarter. And I've found ways to kind of speed up the process, because it's definitely a time-consuming process to do for that. But the point is, I want to do all the sector pricings again now that the first quarter earnings has come out, and then go back through and I should say first quarter earnings, but all the earnings reports as of the first quarter has come out and for my companies. And so I'm going to basically repeat that process once a quarter and probably make a video for it. Previously, I had just talked about it in live streams. Dan, Midas, how do you act when you have a position that is already built and then their next results come disappointing? For example, you have other positions in the portfolio that might be undervalued. You hold it, you sell it to put into other ones. If you sell, how much do you do it? Now, that kind of depends on what we're talking about. If I've already built up to my position pretty solidly, and earnings are disappointing, that depends. It's like, does that earnings affect my long-term perspective on the company, or is that essentially just pushing those cash flows further out into the future because of the short-term disappointment? Because that definitely makes a big difference there. I don't usually just sell a company that I already have a position in just to add to other things that I consider are better opportunities. I would much prefer to just add more money to my portfolio to add to new opportunities. If there could theoretically be situations where that would be the case, but that's generally something I try to avoid in general. Scott asks, type of account matters too? No. Yeah, no, definitely type of account would matter for most investors that are being more efficient in that regards, but my portfolio is pretty much entirely held in a taxable account because of the job situation that I have been in for the last few years. That'll be something that'll matter more to me as I get back to work, as I've been talking about, because I'll definitely be starting to fund up the 401k and the IRA in ways that I hadn't really done before. But when I went to school full time, I actually liquidated my relatively small 401k that I had at the time, and I didn't have a Roth IRA at the time. So my current portfolio, as you see here, is all held in a taxable account, which, like I said, it's relatively small. So I've just kind of been okay with that circumstance. And I do certainly track my net of taxes returns as well as my before taxes returns. You guys don't only see my before taxes returns here, for the record. So technically, if you wanted to think about that, there is potential taxes that would affect these returns as well. But I would also point out that since I've been a student for the last 3 years, my taxable income has been basically nil. And so that's actually put me in a relatively advantageous position when it comes to capital gains taxes relative to if you're a high income earner. So it's a little bit complicated of a situation. But yeah, in general, type of account should matter as well. Anyway, back to Dan's question, to be more specific on it. There's perfect examples I could give you. For example, Interfor is a company I have in my portfolio. It's been a relatively middling size position of mine for quite some time. You can see here, it's actually been in my portfolio for a year and a half in value weighted terms, like how many shares have I bought when. On average, I've held these shares for a year and a half, and I'm still down on them. It's come up a little bit recently, so I'm only down 22% right here, because I think I was down up to like 30 to 35% at various points in there. And so this has been a serious laggard. It's had seriously disappointing earnings at various points, but my long-term perspective, both on the company and on the space in which it operates in, it is a forest operator, hasn't really changed that much. In fact, there's been periods of time where Interfor has been one of the top picks near on the valuation dashboard. It still is. It's literally number 4 on this list right now. So it's definitely something that if somebody does not have a position in the company already, I would suggest that you kind of consider this one. It is a commodity company, so it has serious risk in it. There's reasons why it's performed poorly as it has, and that has to do largely with lumber prices. Now, this chart's kind of ugly to look at because they, unfortunately, the lumber's futures changed the way that they do their contract, specifically the units that they measure in, literally only a year and a half ago, as you can see right here. So unfortunately, we don't have a long-term lumber futures chart here on TradingView. You often have to maybe go to other people who have put together more thorough information on that, like for example your boy Midas right here. So we can go to my lumber spreadsheet, which has more of a longer term chart for that. Hold on a second. Do I not have actually a chart for this one? Maybe I didn't put a chart on it. I thought I did. What happened to it? Oh wait, well I can use the man. What, I feel like this spreadsheet's missing a couple pages. What happened here? Hold on. I think I need to fix something on here. But whatever. The point I was trying to get to is that lumber is down a lot from its peaks, and that has had some serious impacts on lumber companies, and also the profitability in that sector has taken a massive hit due to production concerns as well as inflationary concerns. But I still expect the lumber space to take off like a rocket once interest rates start to be more certainly leveled off, or even potentially start to go down. As you can kind of already see, it does appear to sort of already have bottomed quite a while ago. But that hasn't really flowed through to profitability for a lot of the producers yet. And not to mention, there's been a lot of production problems with some of the producers, including for Interfor. So Interfor is a good example of a company that has been in my portfolio and has just been kind of sitting there. I haven't added to it because I was already up to full allocation for it. In fact, there was a periods of time where my allocation system said I was over allocated to it, and I still didn't trim it because I was under my actual expected value for it, but also was underwater in terms of actual returns. So it kind of depends on the company, but in general, if a company is in a situation where it's already fully allocated and is giving me disappointing results, if those disappointing results aren't affecting my long-term perspective on the company, I just kind of ignore it for a little while. That's usually what I do. I just kind of not pay attention to it and ignore it for a little while. That was kind of the situation with AAP. I honestly, I wasn't talking about it a lot, and I was down a lot on it, and I just kind of ignored it and I just let it sit there. Though in AAP's case, there was definitely moments of time where it was telling me that I should allocate more to it, and I just didn't quite get around to it because I was trying to decipher just how long it was going to take for those results to start to improve, and so I was looking at other things as just being better opportunities. So sometimes when I'm down a lot on a position, because of how I'm allocated to it and because of the negativity associated with it, sometimes I end up not buying more of it when I probably should be, but that's because I'm looking at other opportunities. And you could say that's potentially the case with AAP. And if I'm right about Interfor in the future, that could potentially be the situation with them as well, where I could look back and be like, man, I wish I had actually added more to that when I had the opportunity to, but instead I was being a little bit of a wuss about it, potentially. Scott saying, I need that time graph, please. Talking about the weighted time thing. Yeah, I know you and I have talked about that a few times before. You're like, oh, I wish I had that, but then I've come to it. It's like, this is not the easiest thing to keep track of. Definitely not the easiest thing to keep track of, but it's very, very valuable to keep track of it, because then you can take your total returns plus the time weighted holding of the returns, and then you can calculate what is your annualized return for each of those stocks. I do that for each of my positions right here. So I have, for example, you can see that like on PayPal, I'm up just under 8% on my PayPal position, but I've held it for about 0.5 years in weighted returns. And so that tells me that the annualized return that I've had on PayPal so far is 16.6% per year. This would be like the COGR for it. Which is something that's very, very useful to pay attention to. And this is something I like to look at when I'm trying to consider whether or not I should trim a company when I've only held it for a short period of time. Like maybe a company runs up very, very fast and it's already at your fair value, and there's a lot of risk with it. So you think maybe it could fall back down a bit, and then you're kind of thinking like, oh, I don't know, is this enough returns? It's only 25%. Is that really? Do I want to trim something where when maybe I could get 50% if it's only up 25%? Well, if I look at the annualized thing and it says, well, actually you've earned like 100% returns per year, if you were to hold it for the whole year and it had the same type of returns, and then you can kind of take that into account. So I like to look at my annualized returns, which the only way you can do that is by knowing what your weighted average holding period for each company is. Yeah. Yeah, no, it definitely requires some serious Excel work to keep track of that information. So that's why it's like, yeah, not the easiest thing to do. It's not something I can give you guys either, because I mean, I could give you the spreadsheet that I do it with, but it would you know the same level of information to use it is almost known to create it. So it's not like giving it to you is going to help you necessarily that much. You kind of have to know what you're doing with it in order to put it together. But it is pretty nice. Yeah. And yeah, I mean, if you know somebody who knows how to do a lot of that stuff, they might be able to help you with it. So anyway, let's move on to another topic. Obviously, the name of this stream was Midas on the Move, which was mostly me kind of trying to talk about some of the stuff I've been working on behind the scenes. And I also kind of wanted to, like I said, I've kind of commented on the fact that I'm hopefully going to be entering back into the working space, back to an actual career and stop being a student here in the near future, which I'm very excited about. I've got finally got a really good job offer that I'm very excited about, though contingent on a few details, but we'll see. I have other prospects as well, so if that one potentially falls through for me, we can always look at other things. But the point is, I'm starting to feel very excited about the career opportunities. But beyond that, it's a little bit of a tongue-in-cheek title as well, because I want to talk a bit about gold today. So when I say Midas, we mean literally King Midas today. So gold, and I know I've talked about this at various points in time, but gold is basically at all-time highs, give or take, right now, and has been for a while. It's raced up quite a lot, literally just in the last month and a half. Specifically, ever since the Fed President Waller came out and made comments about how the Fed may or may not want to change the constitution of its treasury holdings over the next year or so. And there's plenty of Fed presidents that have come out to say that, oh, those were even just more speculative comments. They didn't even necessarily mean that they were really even discussing those things. He was just kind of speaking off the cuff. But nonetheless, there's been an incredible gold rally ever since that day. And then it kind of has stalled out at relatively near its all-time highs, and has just kind of been holding the line here for quite a period of time. So something I kind of wanted to talk about was some of the dynamics in the gold space, because I know a lot of people are big fans of the gold space, but maybe don't necessarily understand a lot of the dynamics of it. Other people are very skeptical of the gold space. Here, I just switched to the weekly chart, switched over to the monthly chart. You can see, like, in general, we've been on a very nice upward trend for gold. It had stalled out at some all-time highs back in 2011, and then had come back down to relatively moderate levels for about 5 years or so, until mid 2018, which is incidentally when I started investing. And I definitely invested in some gold stuff right out the gate, which maybe gives me a little bit of bias when it comes to this sector, this little sub industry, as you might expect, because I've definitely had early successes in this space, and I've continued to basically have successes in this space. And so it's kind of become something that I focus on quite a lot, partially because I think that I at least understand the space a little bit better. But it's worth noting that there is potentially some confirmation bias in my attachment to the space nonetheless. But I've also always been a moderate gold bug to a certain extent. To get to the questions I see coming in there, Dan, is my name actually Midas? No, my name is not Midas. My name is Derek. Which I don't mind saying on YouTube. People can call me Midas. They can call me Derek. My name is Derek. And it's worth noting that my name Midas doesn't even necessarily come from the fact that I like gold. I do like gold, but that's not actually why I named my channel Midas. Midas is also the name of a favorite character of mine from one of my favorite books, which happens to be Atlas Shrugged. There is a financier character in that story by the name of John Mulligan, who was a truck driver who turned himself into an investment banker. And because of his ruthless, selfish reputation amongst journalists, there was a point in time where the character gets mockingly referred to as Midas Mulligan in the newspapers. And so this character, John Mulligan, petitions the court to change his name to Midas, which I think my story in some ways reflects that story to a certain extent. So that is actually why my channel is named Midas Investing, is because of this this literary connection to a character from Atlas Shrugged. But slight detour on that point right there. Which, interesting book, very controversial book to some, so I would recommend it to some people, but at the same time, there's a lot of people that might not like it. But nonetheless, a very, very interesting book. But yeah, so I want to talk about potentially why gold is doing what it's doing and why I think that it's going to continue doing what it's doing, or at a minimum stay probably around where it's at in the, kind of the mid to short term, but in why in the long term I definitely think it's going to continue upward. So let's kind of come over to this website here, gold.org, the Gold Hub. You can make an account for free at this website, and it has lots of information on the gold space. It's a really, really great place to like actually get a lot of data from. So talking about like the actual supply of gold, what does the actual supply look like of gold? Currently, the total above ground stock as of the end of 2023 is a little over 200,000 tons, which is a large number in one sense, but it's also a relatively small number in another sense if you think about it. It's a large number in an absolute basis, but comparing it to like other natural materials, other commodities, that's actually kind of a small number if you think about it. Like relative to like say the total amount of barrels of oil that gets traded, moved around, produced, and used all over the place. Gold obviously is actually relatively small. Especially considering the fact that, like I said, it comes from the nature of it being incredibly valuable for tiny, tiny amounts of it. Like for example, it's talking about basically the cubing of it right here. If every single ounce of gold were placed next to each other, the resulting cube of pure gold would only measure 22 meters on each side. So like that's all the gold in the world. It's an incredibly scarce material, and that scarcity is definitely a major reason for why it is incredibly valuable in the first place. Commodities in general have done very, very well, but gold in particular has done particularly well in the last month or two, and it has to do, like I said, with some people's perspective on what's changing in the monetary environment significantly. So, what is the gold supply, and where is it actually held? About 45% of it is actually just jewelry. 45% of this above ground stock is just in jewelry. 22% in bars and coins, and that includes the gold that is held in vaults to back up the ETFs. People often talk about the gold ETFs and think about like whether or not that counts as real gold. And it's like, well, for the gold ETFs that are out there, there is actually gold in a vault somewhere backing those ETFs up. From a legal perspective, assuming the ETF is held in a jurisdiction where you believe that the legal system is strong enough to essentially make sure that that's really the case, which is, in my opinion, would be the case for certainly American ETFs and British ETFs. Beyond that, I tend to be a little bit more choosier about which legal jurisdictions I trust over for some things over others. But nonetheless, they're still there. 17% of the current above ground stock is held by central banks as well. And then 15% is held in other, as they put it here, which is largely going to be in industrial stocks. There's going to be like a significant portions being held by various industries, as well as dentistry being a significant industry, not just electronics. But gold is also used pretty significantly for industry. Now, this is again just the kind of inventory. This is just the above ground stock. This isn't necessarily like the actual demand itself specifically. And then there's proven reserves, which is gold that has not been pulled out of the ground yet, but is believed that it is economically feasible to do so, generally speaking. And that's potentially another close to 60,000 tons, which if you kind of think about that, that's close to another 25%. We could theoretically increase the total gold supply by about 25% if like all the miners kind of just ignored what the impact on the gold price would be if they pulled it out of the ground and they just went to work and pulled it out of the ground. And keep in mind, this is all the gold since the beginning of time that we've collected. Since the beginning of history, that's all of the gold that we have collected. So it's kind of interesting to think about. That's very, very, very interesting. Because it's not like even the gold that's used industrially, it's not like you can't get a decent portion of it back. So where is the gold? Where is the gold specifically? Here's all the gold reserves held by specific countries. Obviously, there's a huge amount of it held in North America. Very specifically, we're talking about just the reserves. So this is the gold that's held by governments, effectively speaking, largely central banks, but technically it's not necessarily a central bank. Sometimes it's just governments in that sense. But huge amount of it being held in North America, a decent amount of it being held in Western Europe. Beyond that, decent chunks held in Central and Eastern Europe, and then definitely significant portions being held in East Asia. Increases in the recent what time frame is this on? It might be just the most recent quarter that they increases on it. Let me switch over to an annual increase. Yeah, over the last year, China being the largest increase in their total reserves, which is pretty interesting to think about. Poland, Singapore, significant decreasers. Kazakhstan, Uzbekistan, relatively smaller impact kind of levels. So coming over now, let's think about like the actual supply and demand statistics. This is probably some of the stuff that's going to be very interesting to understand, like why the prices are doing what they do. This is, first of all, we're looking at demand first. This is the total demand across all the different categories. So we have jewelry fabrication, technology, investment, central banks, and then on the backdrop against that, we actually have the gold price itself. Gold here, the price on the right, and then the tons of demand, which on an annual basis, going back to 2010, for each of these categories. So right off the bat, I kind of want to point out that central banks, you can see, is a relatively small chunk here at the bottom. It definitely has its effect, but it's a relatively small chunk. We can take each of these chunks out. So if I click here, we can remove the central bank category. And then there's also investment, which investment is, a broad category that includes a lot of things. We can click on each of these little categories here, and it'll give us some like sub thinking about that, but we'll get to some of those later. I kind of want to focus in specifically on jewelry fabrication and technology, because this is more of the, like, what I would say is an industrial use for it. Now, I would say jewelry fabrication, it gets a little bit complicated when you're thinking about it, because jewelry fabrication, you could think of this as, people want it because it's pretty and because it's a good metal for making jewelry out of. And it's also a status symbol because of how expensive it is at the same time. But that it's also has almost a positive potential monetary purpose there too. A lot of people might buy gold jewelry with the thought that, oh, this is something that is valuable enough that I could theoretically sell it again in the future. So people like to separate out what is the monetary demand versus the industrial demand. And kind of think about those things, versus also we'll add a third category as speculative demand as well. So like that's kind of the three camps I want to think about the demand for gold: a monetary use, an industrial use, and then more of a speculative use. So what I would say is that when we're thinking about jewelry, I would probably half and half in those categories. There's like probably half of the jewelry is thought of as just an industrial use, and then half of it is probably thought of more specifically as a monetary use. Whereas the technology use is purely industrial. Okay, so if we're thinking about like it's the level of industrial use, maybe it might be halfway up this chart, because most of it is made up by the jewelry fabrication part. So potentially maybe around 1.5k tons per year. Obviously there's years that were particularly low, like 2020 right here, but kind of like 1.2 to 1.5k tons is probably the level at which I would say that you could argue is where the industrial demand for it comes from. And then compare that again to the total demand that we have, which is kind of like hovering above 4K on average, maybe 42K. So at which point you would say it's maybe like 25% of the overall annual demand over the last, what is that, 13, 14 years has been essentially for industrial purposes. So it does have a relatively significant portion being used there for that, but obviously that's not for everything. Now, some people find that to be concerning, because in their minds it's like, well, can we really rely on the more speculative and also the monetary uses to be a real value to it? A lot of people don't like the idea of thinking of a commodity just as money. They want it to have a real end use, because a lot of people say that the reason why people think of it as money is because it has a real end use, which I would say is definitely true. But then it kind of, like I said, it kind of comes down to this funniness about thinking about what the jewelry fabrication actually ends up being. Now we can click on these individual levels, and it actually gives us a little bit more information on that. With jewelry fabrication, it gives us separating out the consumption of jewelry versus the levels of inventories it's used at, which is actually has an almost moderate impact on it. But we can do the same thing for technology. Technology includes electronics, dentistry, and other industrial. It's worth noting that dentistry is a relatively small portion of it. And then we can also narrow in specifically on these subcategories. So dentistry, it's actually been going down very significantly over the last 14 years. And that has largely to do with just how expensive gold is. Why use gold for your fillings in dentistry when you can use so many other things that not only are cheaper, but also look better as a tooth replacement, right? So over time, this particular segment has become not a really major factor when it comes to the demand for gold, which is fine, because as we kind of pointed out, it is almost none of it. It's like this is the technology use, and it makes up this tiny slice of that, and then technology itself makes up a relatively small slice of the overall demand in it for itself specifically. But coming back over, we can also pay attention to the other industrial, which is also a relatively small slice. It has come down over time for probably much similar reasons, which is to say that it's expensive, so people will tend to look for other alternatives. But at the same time, it may not be as easily replaceable as it is with dentistry. So that what has come down in a lot of large ways, it has kind of leveled off in terms of its decline. Now, electronics is a little bit more of the interesting one. This one has come down as well, but at the same time, it's had its periods where it comes back up. And when it has had its periods where it comes back up, you can see, for example, in 2020 and 2021, it moved it upward right here. That happens to be at the same time that gold was moving upward in price. And I kind of want to point that out because it kind of shows that while this was coming down, it wasn't having a huge effect on it. But suddenly when companies who have large amounts of money to spend are suddenly saying, hey, we actually need gold for certain types of our electronics, it can actually have a relatively large impact on the price during that time frame. And then it's come down in 2022 to 2023 to even lower levels, but obviously you can see the price, it has still continued to be upward on that. And that's actually going to be a trend that we'll see in a lot of different ways, because that's one of the interesting things about this is how many of these dynamics have shifted over time. But nonetheless, gold has leveled off in price for the last 4 to 5 years anyway. After making such a large increase since 2018, as I was talking about. So let's come over to the investment category. This is where stuff gets interesting. And it's worth noting that of these tabs where we can break down by the categories, we don't get one for central banks. So actually, let's talk central banks before I get to the investment category. We narrow in on central banks, which is, again, a relatively small chunk of it, but this is another segment that I think has a very large impact on the price, depending on what's happening in the space. You can see that we relatively leveled off over time when the gold price was coming down. We had lower levels of demand through these years, but it's worth noting that we still have positive demand for central banks basically every year. Central banks are still buying it all the time, and that's something that I think is worth paying attention to. Now, coming over here, we see that the gold price went up even during years where the central banks weren't necessarily buying a ton, like 2020 and 2021. And then suddenly in 2022 and 2023, it spiked up to relatively high peak levels of demand. Which kind of, I think, goes to show that central banks were a little bit late to the party when it comes to thinking about using it as an inflation hedge or something like that, and considering concerns about the dollar, potential for the actual value of the dollar to go down once interest rates start to go down. The dollar has been very strong because of the interest rate raises. And it's worth noting that because interest rates act as a pretty significant competition, essentially a proxy for competition against gold itself. And the reason why is because gold doesn't give you any interest. So if you're going to hold gold instead of, for example, treasuries, then that means that you're essentially foregoing the potential for interest because you're wanting the potential capital appreciation for gold, which comes but often can take a long time to show up. So I kind of want to point that out, both because, like I said, it shows that the central banks can be late to the party, but for some of the reasons that it's held up so strong in 2022 and 2023, despite the high interest rates, I think that has to do largely with central banks buying much more than they previously did before. And that, like I said, that actually makes up a relatively small chunk of the overall demand, but it makes up a big chunk of the increase in overall demand in the last couple of years. Now, coming over to the investment category, this one is a little bit more complicated because it includes a lot of negative years in one of the categories in particular, that being ETFs. Now, there's physical bars, official coins, and metal bars. We'll take a look at those specifically. This is actual physical gold being sold and held by retail investors, but also by sophisticated large investors. Retail investors are probably more on the official coin space in particular. And then the physical bars is probably more likely to be like other investment funds or family offices, billionaires, things like that. And the metal coins is kind of similar to official coins, but it's coins that don't actually have a face value in terms of monetary value. You can buy a gold eagle American gold coin, and while it has a gold value to it, that is the thing that you're buying it for, it's the price you pay and it's what you would theoretically sell it for. But there's also an actual monetary value to it. You can theoretically use it as dollars. Now, of course, the dollar value you get is garbage, so nobody would ever actually do that because we haven't raised the actual value per dollar for gold since 1971. But at the same time, it does theoretically actually have a monetary value in the same way that a quarter does. Now, that's not the case for the metal coins. Metal coins is more like unofficial coins that have been made for that. And like as I was just showing there, it's a relatively small space in particular, but it's an interesting space to pay attention to because this is the space where a lot of emerging market nations that have populations that are big fans of holding large amounts of gold. This is actually where a lot of that demand tends to hold up. And specifically, for example, India makes up about 75% of this entire category right here. The metals coin section of the investment, which, as I kind of showed, is a relatively small portion of the overall pie of investment, which itself is a moderate portion of the pie of the overall demand. So it's not necessarily a huge portion of it, but like for example, this is how a lot of the Indian citizens like to hold their wealth. And I saw Dan mention, for example, that Iranians love their gold as well. I think this is also where you would find a lot of the Iranian demand for gold in particular, from the citizenry in particular. So something it's very interesting to pay attention to because, for example, you can see that this has been on a nice even come up ever since 2019, where it bottomed here. And 2020 was a little bit higher than 2019, despite the fact that the demand levels in so many other categories was down in 2020. It was technically up in this year. And then 2021, it raised up even more, 2022, even more, 2023, even more. So I think this shows that the kind of underground retail demand, especially around the globe, for forward gold has been coming up a lot in these years too. And I think that's had a pretty big impact on the price as well. Now we can move over to kind of, like I said, the more the investment of probably more sophisticated investors on the physical bar side, and then there's probably more of like a developed market retail investors is probably more of the official coins level. So this is probably like a lot of the American desire to hold gold, as well as potentially some other more developed nations as well, but not just America. But I imagine American retail investors make up a large section of this particular slice of the pie, and then probably like money managers makes up a pretty large portion of this pie. And you can see that money managers tend to chase the opportunity as it seems to be, and it looks like they're slow to get back in because of the way that they've probably been burned in the past, like back in 2013, for example. So that's a pretty, I think, thorough overview of kind of like the different types of demand for gold, whereas we're just focusing specifically on demand. There is this other thing where we can flip over to supply, which has a lot less information to it, but nonetheless, we can look at it very briefly. Here we have it kind of largely sectioned off into three categories, that being mine production, recycled gold, and then net producer hedging. You can not even barely really see where the producer hedging is. And this has to do with specifically mines that are being part of the hedging portion, holding sections of it on their balances, the inventory balances, and then selling that into the market or buying it back. Which you can see is, as a hedging, there's often a negative level to that in any given year, but as we were just showing, it makes up almost none of the overall levels. Now, mine production itself, we can narrow in specifically on that. We can see that mine production was actually increasing year after year, even after the declines in gold price in 2013 and 2014 and 2015. Mine production continued upward, which is probably one of the reasons that the gold price stayed as languid as it did for so many years, and then it actually peaked back in 2018. That's interesting to know. Gold mine production levels reached a high back in 2018, and then they actually went downward for a few years, down into 2020, which pretty obvious for 2020, but 2019 as well. And then we started to move back up in 21, 22, and then 23 is kind of at the same level as 2022, which is still down a little bit from the 2018 level. So gold prices have come up. Probably a decent portion of that has to do with the fact that there was less supply coming onto the market as a result of that not reaching that same peak level. And then I would comment on this in particular because I do know that a lot of the large gold producers have been essentially guiding for not necessarily the most impressive increases in total production over the next few years. And so that's another reason that I think that there's reasons to believe that this gold price at a minimum is likely to hold up at these relatively strong levels, if not continued upward at a relatively brisk pace. All right, so that's enough of talking about specifically supply and demand. There's a lot of information on this one page. That's why I definitely wanted to go through a lot of it. And we'll definitely go with a few other things. Here is a quick map of overall mine production around the globe. You can see that the largest gold mine producers being Australia, China, and Russia, very clearly so, while North America itself ends up being a pretty strong place for production as well, but definitely much weaker than overall for them. And I want to kind of comment on that because obviously there is a little bit of a multipolar kind of dynamic that's starting to grow around the world, where we're starting to almost see countries kind of fall into different camps in terms of like almost similar to how the Cold War was, where we had the first world versus the second world, and then there was also the third world, which referring to basically all the unaligned countries during the Cold War. That is the origin of the term third world, by the way. It doesn't mean a poor country. Third world actually just means unaligned to the Cold War. But first world versus second world, it kind of looks like we're almost creating some similar dynamics lately in the last few years. And I comment on that because, as I said, two countries that are somewhat unaligned with America on a political basis, on a global basis, happens to be some of the largest producers of gold. And the way that that could have major impacts on the overall price dynamics around the globe, if, for example, these two countries were to stop having as good relations with America, even more so moving forward. Potentially, for example, maybe Russia would stop allowing their gold to be sold to nations that are not friendly with them, for example, something like that. Now, obviously, there's still Australia, as I was pointing out before. And then I also wanted to point out, as we were talking about before, the fact that India actually is a relatively large gold demand location. You'll see that they are not a producer of gold themselves. And then I would also point out that India has not the greatest relationship with China as well. So I could imagine circumstances where they themselves are potentially cut off from gold supply related to those figures, while they do have much better relations with Russia. So it could be a little bit of a an either or in that sort of circumstance. So what I'm saying is that I can see circumstances where gold prices actually start to divert a little bit, depending on what region in the world we're specifically talking about. Potentially, gold prices could be a bit lower in this kind of section of the world if they're not going to be interacting as much with this section of the world, and then this section of the world might end up having higher gold prices as a result of that. That's a little bit of a speculative idea, but it's something that keep in mind, the kind of macro politics of all the countries that produce gold as well. So now a few other things kind of want to point out. Specifically, we're going to go in and narrow in on ETFs. Like I said, a lot of people like to talk about gold ETFs, as I was commenting before. So some people are skeptical about whether or not gold ETFs actually have the gold that they claim to have, and then also the dynamics in it. And if you'll remember, when we were looking at the investment categories, we were finding that ETFs themselves had actually been a negative aspect of the investment category for some years, which we can see right here. If we focus in on the yearly levels, they've been net sellers of gold for the last 3 to 4 years, which is very interesting to think about, considering the fact that gold has been up at some peak levels ever since that last time that they had an inflow, which was in 2020. And as we're knowing, 2020 was one of the largest inflow years that ETFs have basically ever had. So the fact that they had a large inflow year here means that it's not too surprising to see some outflows in the following years thereafter, almost as like a balancing out to that effect. But nonetheless, despite all of this in selling by speculative investors, because I definitely think the ETF category is very representative of speculative investing in gold, the fact that these guys have been outflowing for 2, 3.5 years at this point, and we still have gold prices at the relatively high levels, and in fact they've moved to peak levels in the last few weeks and months, is very interesting to see, because obviously at some point or another speculation will come back in. So at what point do these ETFs start to go inflowing again, and where does that push the gold price to next at that point in time? Something definitely to think about. Think about, for example, how nicely well tied the upward movement of this yellow line is to these inflows during these years, and then boom, as soon as we have a big outflow year in 2013, that's when the gold price comes down. Outflows for 2 years thereafter, inflows again as the gold price starts to recover a bit. A little bit of a mixed year in 2018, but then 2019 in 2020 we had large inflow years, and that's when the gold price started to move upward. So one thing to be very much to be paying attention to is when this trend starts to reverse, because this is the thing that could really start to rocket it upward. We've commented on a few of the other categories and how they're probably allowing the gold price to kind of hold up in the short term, like for example the central bank buying, but at some point or another, I think the speculative investors will realize they're late to the party, and they will rush back in the door, pushing the price even higher. Now, futures positioning. This is another interesting category people like to talk about. I'm not only going to make a few specific comments on that, because there's kind of some other, I think it was on the next page. Yeah, there's some other stuff I want to comment on. People tend to be even more skeptical of the futures market because of the fact that of how futures markets work. You can trade contracts on gold, but not actually take delivery for the gold. And that means that unlike the ETFs, where there is actually legal entities that are making sure that those ETFs are backed by gold the way that they say they are, the futures market is just people promising to pay each other in gold under certain circumstances. So if we don't actually see those contracts be called in for delivery, then that means you don't necessarily know what the actual value is in those relative terms. Now, it's very possible that, for example, a huge portion of this demand, this is the open interest for the futures market, and here's the net long positioning for it, for COMEX in particular. So I kind of want to comment on that. The COMEX section of this chart, if you look at like the last year, it says that the COMEX makes up about 116 billion USD relative to the close to 150 billion right here. So that makes up like about more than 3/4 of the total open interest is on the COMEX futures market. And if we come down here, this is specifically focusing on COMEX. That's why I wanted to make sure you know that it's not technically the whole market when we come down here to see the net long positioning, but it is the vast majority of it. And this is mostly money managers creating net long positions and then other net longs. Now, the reason why it's interesting to pay attention to that is because the futures market is for people who need gold in the future, gold producers and gold consumers, major like technology companies that would need them in the future might buy a futures contract to make sure that they can get the gold they need in the future, but lock in the price today. That's essentially what futures markets are for. But you can see that more than half, sometimes 2/3, sometimes even close to 3/4, depending on the year, I'd say over the long run, it's still maybe about half. But half of the net long positioning in the COMEX futures appears to be money managers, which itself is kind of speculative. These are the people that are probably not actually going to call that gold for delivery, because if you call the gold for delivery, you're going to need to have a vault to keep it in order to keep it safe, or you might need to outsource some of that information in the first place. So this is the area where people look at the futures market and say, this looks kind of speculative. This is the section that maybe is kind of a fake portion of the overall demand levels. Now that's true, but again, I would point out that, like, for example, we saw that the ETF speculative section was going through outflows, while we see the COMEX, the futures market, having more of net long positions themselves. So I personally don't overly worry about it because I kind of think of them as pretty largely balancing each other out, but this is a section of the market that people tend to be a little bit more skeptical of. And then what I think it really does is it creates dynamics where obviously in futures markets you have a price that's slightly different from the actual spot price. The price of actually buying gold versus the price of buying a gold contract for the future tends to be slightly different because of the ways in which the different value of time over the time frame is held. For example, in futures markets in general, there's a concept called backwardation and contango. Contango refers to the idea that the price in the future is generally higher than it is in the relative to buying the spot price in a present value sense, and then backwardation refers to when that dynamic gets reversed. So like for well, this is actually the futures one. This is a futures contract for gold itself, but we could also look at gold spot prices, and you would find that they are slightly different on that sense. Or actually, no, that's the spot price, my bad. But we could also go to the gold futures to 2165.04, 2160 flat. So you can see there's a few dollar difference showing that the futures market is actually slightly down relative to the current future price, but that's on the price today relative to, for example, several months forward, which gets you a slightly different level on that. Aryan, yo. Aryan's asking about INMO and Tesla. We can maybe look at some specific companies once I finish my kind of overview of the gold market. That's kind of what we're doing right now. I definitely can talk about INMO, but I mean, I've talked about INMO in lots of other places too. And Tesla, I'm not really that interested in talking about, to be honest. Maybe we can maybe take a brief look at them, but like, to be honest, it's like I don't really have. I do have lots of kind of negative thoughts to maybe say about Tesla, like why I think that are going to be facing difficulties, but I don't really have major thoughts on their overall valuation. I haven't really thought about them in that sense for quite some time. So where was the? There it is. Okay, so if we go to the gold futures chart, you can see right here, this is the expected price at various points in time based off of the way the futures market's currently set up. As we were just kind of commenting on, the current price is around 2160. But then if you look at the way the futures market is set up, people seem to believe that over the next 12 months, it's going to move back up to upward highs close to 22 to 2300 over the next 12 months. 2250 appears to be the contract for about 11 months out. And then if we go to say 2 years out, you'll find that's 33. Kind of halfway in between, or 2 years out, people seem to expect it to be around 2300. And then if you go all the way out to about 5 years out, which is like 60 months or so, right around here, people seem to be expecting it to reach almost 2500, which is remarkably consistent with the model that I put together close to a year ago for gold prices, which I did a live stream on. And let's see, it's this one chart right here, where I essentially tried to make predictions for various commodities, but specific, we're talking about gold right here, by essentially looking back at the past and using fundamental data as well as some statistical data to try to determine what the gold price should have been according to my model, which is, you can see the blue line is the actual average price of gold within each of these year points, and then the red line shows what my model price said the price was going to be. And within a certain error range. So as far as I'm concerned, as long as it falls within the beige box, it's actually within the range that it's effectively saying is a reasonable expectation for where the gold price would be. And it managed to successfully predict every year except 2 years, which happened to be the peak prices we saw in 2011 and 2012. Because of the fact that it failed on 2 years rather than just one, because one would have been a statistically acceptable fail rate. So it went outside the acceptable fail rate. That means the prediction that I have for the future prices I found to be only so reliable. So while the red line, the bright red line, is the actual centered prediction, and then the beige or yellowish area shows the kind of the error range that I find to be an acceptable range of expected price for the future, the next 10 years. These dark red lines is me essentially adjusting that range downward by one standard error to adjust for the fact that the model failed by more than the acceptable failure rate. So if you just take the model as given, my expectation for the gold price 10 years from now, or at least 10 years from a year ago, 2032 average prices was about 31 to 3200 an ounce. But if I was to adjust downward based off the failure range, I end up getting 28 to 2900 an ounce. But it's also interesting to note because, well, what did it say the expected level was going to be for 2023? It said it was going to be 2400, possibly down on the actual normal model to possibly around 1800. So essentially, I said that I could see gold prices anywhere between 1800 and what was it? This stuff right here. 1800 and 2900 would have been acceptable for last year, and then obviously 2024 at similarly kind of levels, but a little bit higher. But the failure range adjusted down to potentially between 1700 and 2900, which the midpoint of that point ends up being 22, 23, which is interesting because that's kind of similar to what the futures market seems to expect for the gold price in this year as well. Now, the only reason I made these models was because I wanted to have gold price expectations for the futures that I could make my valuations around. Though I only rely on this model to a relatively minimal level because of the fact that I consider it not necessarily the most strongest method for trying to predict gold prices, and there's lots of other people that try to predict gold prices and do not succeed at it. So it's not like I expect my method to be some magical panacea to dealing with this situation. But the point is it seems to me that I expect gold prices to go up on the fundamental basis by which I've made predictions for it, but it also seems like most investors are currently expecting gold prices to go up pretty significantly as well, at least according to the futures market. And then I've explained a lot of the supply and demand dynamics for why I think that that's pretty likely to be the case as well. Now, something I also commented on with a decent amount of the discussion around those commodity price models that I was making was the try to get rid of all this stuff, is a concept called the ASIC chart, the average all-in sustaining cost chart, which is a concept for using commodities to determine like what is the kind of sustainable level at current production levels for a certain commodity price. What is the actual production cost for the companies being produce it? Now here's a weighted average for the production chart over time going back to 2012. So you can see like for the average producer of gold, what is the actual cost per ounce to produce it, and you can see like how well that correlates with the actual movements in the price itself. It's significantly below the actual price of gold because obviously they want to have a profit beyond that. And then there's all the speculative actions on top of that. But something that to point out is that the costs of producing gold have been going up, which is something that is going to push prices up as well. It's like, you know, at its core level, people aren't going to sell their gold for less than they cost them to produce it, right? Unless they believe that for some reason they need to be doing some fire sale, which is not usually the case for something. Now, this is a time series chart where, like I said, we can look over the last decade to see how the costs have moved upward over time, and we seem to be moving upward, even though inflation has kind of leveled up. The gold ASIC production inflation has not leveled off, as you can see. It's still moving upward at a pretty decent clip. And unfortunately, I wish I could have turned it into annual. This chart doesn't allow me to do annual, only by quarter. But coming down here, this is a concept I've talked about before with oil and copper, and this is a very, very important concept to understand when it comes to commodities in general. This is an average of the AISC, the all-in sustaining cost. This is the curve of all of the producers of a commodity. And so when people talk about the ASIC curve, when they're talking about commodities, this is what they refer to. Now, this is like saying take all the producers of gold on the planet and put them all in a line with each other, from the beginning of 0% of the cumulative production of gold all the way up to 100% of all of the production of gold at a given point in time. And at what point on the ASIC curve are they? So you can see like there's producers up to essentially the first 10%, the cheapest 10% producers of gold produce their gold at less than $1,000 an ounce, or actually it goes up to more like 15% where it reaches that actual $1,000 an ounce line. So there's 15% or so of the producers of gold actually produce their gold for less than $1,000 an ounce, which means that if it's selling for over $2,000 an ounce, they get to keep over half of that as production profit. Obviously, that doesn't take into account SG&A and lots of other things. This is primarily more like cost of goods sold kind of thing. And then if you come up over here, you can see that all the way up to say about 1,500 or so, which is maybe about halfway up the line here, it ends up being more like 2/3 of all producers to get up to can produce their gold for less than 1,500 an ounce. So you can see a huge amount of people essentially sit there between 1,000 and 1,500 an ounce for their production level. A huge amount, basically like half of them all to get all in. And then obviously way up here to where the current gold price is, which is at like around 21 to 2,200, that's basically around 95%. So about 95% of all current gold producers, all the mines in the world that are currently producing at a sustainable level, about 95% of them are doing it at levels of the current gold price or below. And then there is going to be about 5% of gold mines that actually produce at levels much higher than that, all the way up to, as you can see, some pretty high levels that it actually spikes up to. Now, this concept is important to understand because it's not a coincidence that we see the gold price trading at around the 95th percentile of the ASIC curve. That's actually something you see pretty common in commodities, is that commodities tend to trade somewhere between like the 98th and the 90th percentile of wherever their ASIC curve is. And that has a very substantial effect on like where the price goes. Now you have to kind of think about like how supply and demand dynamics work. Okay. Think about it as there's nobody selling gold and there's nobody buying gold. Now producers come online to the market. It's going to be the people who see the highest profit opportunity in gold. So that means the first people who are going to choose to be like, I'm going to start a gold mine and I'm going to sell gold are going to be these people here at the bottom end of the curve. So some of these people come onto the market and they start selling their gold, and then people come onto the market and start buying that gold. Now, people always also, not only do people want to produce their gold at the lowest level so they can sell it for the highest price, but people who buy gold also want to buy it for the lowest price. So you're going to go to the person who's willing to sell it to you for the lowest price. And who's going to be willing to sell it to you for the lowest price? The people who have the lowest production costs. So the first buyers and sellers are at the bottom of the curve. And then as more people add onto the market, you add more gold mines and stuff like that, all the way up the chain to the point where the very last people who are buying gold, the very last ounce that's being bought on the market, the where the supply and demand actually level off, is going to be at the highest point of the curve relative to that actual demand level, relative to the total amount. So the idea is that every time a new buyer comes on to the market, they have to buy over here. Okay, like that's how it works, is that they have to buy at this point on the curve relative to people who have already bought it back in the day. The reason why this matters is because if more demand comes on and less supply is coming online, like if supply stays flat and more people just come onto the market, then that means that you can see that why commodity prices do the moves they do, because they can spike up in dramatic ways because of the fact that you can't just produce more gold at this level. You have to find a new mine that's going to be able to produce at this level. But if you're talking about mines that already exist, they're only going to be able to give you the next ounce of gold at the next point in the curve. It's basically like saying if you're standing in line to buy gold, you're standing in line over here. You're not standing in line over here. And so that's why if demand for gold increases by even just a percentage point or 2 percentage points or even 5 percentage points, it pushes this curve up right here. And then obviously, as we are also commenting on, the average cost on the ASIC curve itself moves up over time with inflation. So as this curve goes up, it's like pushing essentially the bottom end of the curve upward. And as the bottom end of the curve gets pushed upward, that pushes the middle section of the curve upward. And then the middle section of the curve pushes the upper end of the curve upward. So there's kind of multiple dynamics that goes into that. And then, like I said, this concept is something that isn't just in gold markets. This is something that applies to commodity markets in general. It's like you're going to buy the commodity for as cheap as you can, and that's going to mean that you're like the people that are waiting in line to buy the next batch of the commodity is going to be these people buying at this end of the curve. And the 95th percentile is a very common rule of thumb that people like to state in commodity markets as being a place where the price often settles at. If you see if you see the price go below the 95th percentile of the ASIC curve on a commodity, like I said, it's a rule of thumb. It's nothing magical about that. It's just a rule of thumb. But that's the point at which people stop to produce at those higher levels, which cuts supply off of the market, which means the next people that want to come onto the market to buy then have to push the curve back up, which then pushes producers back onto the market. So commodities tend to not go too much lower than essentially this kind of range right here. And then, as we saw over time, that range gets pushed upward as well. All right, so that's my overview of. Oh wait, no, there's one more page that I kind of wanted to comment on. This website also does some surveys of central banks, and we were talking about the central bank demand for gold being not necessarily the largest slice of the demand for gold, but it having a relatively large impact in because of the way that it kind of moves and changes depending on the circumstances of it. And they do surveys of central banks around the globe, getting an idea of like what do they think about gold, what is their plans regarding gold, and we'll see what they have to say on that regard. So taking a look at it, half of central banks surveyed believe the percentage of reserves of USD in 5 years will be between 40 and 50%, while just over a quarter believe it will remain unchanged. For context, it's worth noting that the current reserves held in USDs, I think around 55%. I mean, it's like 55, maybe up to 60% currently. For central banks around the globe. So them saying that half of them believe that it'll be between 40 and 50% means that there's an implied moving away from the dollar hidden in those in that question here. And then obviously they have a little bit of a distribution showing here less than 40%, relatively small amount of people that believe it's going to push back over 60%, relatively small amount of people that believe it's going to stay kind of unchanged. Okay, well actually it says unchanged. It seems to be implying is at around 51-52%, because that's seems to be the point right here. So yeah, like they seem to be implying by this chart that it was 51% last year. I hadn't seen the reserve data from last year, so I wasn't sure. Last I saw it was like 55%. So so it seems to be that a lot of people believe that dollars are going to be sold relatively on average by central banks over the next 5 years. I would argue that you could also see a reversion to mean, which would be pushing it back to the 52 to 60 category. So I personally actually believe that it is probably more likely to be unchanged and to 52 to 60%. But again, this is about what central banks believe, because what central banks believe is going to drive what their decision making is going to be. And also, it's worth noting that if they're not holding USD, they have to be holding something else. Now, obviously, that could be other currencies, but it could also be gold. So that's one of the reasons why we're bringing that question up. A majority of central banks expect a slight increase in the proportion of total reserves being dominated in gold over the next 5 years, with developing economies primarily driving this view. They do have these charts sectored off by advanced versus developing and other categories as well. I'm just kind of mostly looking at the total category itself. But a significant portion believe it's unchanged, but a significant portion do believe that it's going to push upward to 16 to 25%. Which I'm not 100% sure what that means by that, like what their category is dominating, and it seems to be implying that the current reserve levels is on average around 15% based off of that percentage there. So likewise, where we see a large portion of people believing that the dollar is going to go down, a somewhat similar level of the distribution seems to believe that the gold is going to go up in terms of those holdings. Now, I saw Dan comment at one point for why it is that people like to hold gold, often being a hedge against inflation, as well as against a diversifier against certain types of risk. They actually ask them about what is the reasons that people seem to care about in terms of that. Historical position, performance during times of crisis, long-term store value / inflation hedge, effective portfolio diversifier, no default risk, highly liquid asset, serves as a geopolitical diversifier, and then a variety of other things right here. Now, they kind of categorize it into highly relevant versus somewhat relevant, and then marginally relevant, and then not relevant at all. What I'm like to do is here, I'm going to consider the major answers as basically a combination of these two categories where any of these answers end up making up more than 50%. So like, for example, we can see that more than 50% is essentially in those top two categories, all the way down to, what is it? All the way down to basically here. And this is where it reaches 49%. Concerns about systematic financial risk is 49% for those two categories. So just above that is serves as a geopolitical diversifier. So the major reasons that central banks seem to like to hold gold is that historical position being number one, which is interesting. We used to do it in the past, so we just continue to do it in the future. That's interesting that that's literally the number one reason. Not exactly the most exciting of reasons, but it's interesting that that's the reason. I think that's definitely a large case for the U.S., being that that's the central bank that holds the most gold, not as a percentage, but in absolute terms. Performance during a time of crisis, long-term store of value / inflation hedge, effective portfolio diversifier, no default risk, highly liquid asset, and serves as a geopolitical diversifier. Now, all of those things are stuff that we've kind of commented on in a lot of the supply and demand dynamics. So I think that's interesting that we see that central banks themselves believe in those reasons, generally speaking. 7 in 10 central banks surveyed believe that gold reserves will increase in the next 12 months, which is a 10-point increase from last year. Very, very interesting to see that. You can see kind of over the last few years, how much do people seem to believe that their reserves are going to go up in the next 12 months. And a reminder that these 3 years are the years where we saw significant central bank buying. 2020 and 2019 were much more moderate central bank buying years, but nonetheless, they still seemed to believe that there was going to be a lot in the following year. So in 2019, they said there was going to be a large increase in gold buying in the next 12 months, and we didn't really see that in 2020. You could argue that COVID might have thrown off their plans there. It spiked up significantly in 2020, which was also probably decently because of COVID, but they actually ended up being right here because in 2021, they ended up doing significant buying. The number dropped in 2021 after they did do some significant buying, and maybe they thought they were going to do less because they already did some previously, but nonetheless, it did increase in 2022 and in 2023, and then those numbers started to come back up over time. So it seems like maybe they were buying strategically in these first few years, but now it seems like the demand and the desire for the demand is continuing upward over time. So people seem to believe that central banks seem to believe that they're going to be buying a lot in 2024. Interesting, we were already seeing that they're starting to do so, but obviously it's early in the year, so we don't know exactly how it's going to pan out. And then the last question, it has, similar to last year, a strong majority of respondents do not expect the level of gold reserves in their institution to change over the next year. Around a quarter anticipate an increase. Now, I remember when I was looking at this, I kind of thought it was a little bit strange and hard to determine exactly the differences between these, why there's a major difference there. It's like kind of the wording isn't super clear. A strong majority of respondents do not expect the level of gold reserves in the institution to change over the next year. Does that mean that they expect gold reserves are going to increase in the next 12 months, but they don't expect the level to change? Does that mean that they're talking about like a percentage of their portfolio? It's a little unclear. I wish there was a little bit more clarity around this specific question right here. But all right, so that's the end of my my gold overview, my gold market overview. I did, like I said, I know not everybody's interested in gold in the same way I am, but it's something that I have paid attention to basically as long as I've been an individual stock investor. It's a space I think I understand pretty well, and I've in general done pretty well on it. As I've kind of was pointing out before, we have Silvercorp, which we made a pretty solid bet on, which despite the name is in the process of becoming half a gold producer and half a silver producer, even though they're currently primarily silver. But that's part of the reason that they've done so well. New Gold is a company that I've invested in recently that's done really well. Barrick is a company that I've also invested in that hasn't done as well, but is a company that I'm actually down on this one, and it's one of my longest term holdings. So that has not been super great for my annualized returns, although it's also given me some decent dividends over the years as well. So if you count my dividends, I'm only down 10% on that position, which is not great considering I've held it for a few years. But nonetheless, that's actually one of those larger producers that has had difficulty expanding its production in the way that it had previously promised to. So I think that's part of the reason it's underperformed. And it being one of my older holdings, you can see that the companies I've shifted to over time in terms of the gold space has been to smaller positions that have been working on expanding the production and actually are small enough to make that a little bit of an easier jump. Whereas when I initially got into Barrick, it was because it was a larger producer, and I considered that diversification to be a little bit more of a safety buffer. But honestly, looking back, I've kind of learned that I don't necessarily agree with that perspective anymore. It's safe to diversify your asset base globally, but gold is already mined in so many less than nice places around the globe that it makes it, I think, a little bit trickier to actually be sure that your diversification is actually giving you less risk. Because if you're just putting another mine in another risky area on the planet, you're actually just creating one more potential way in which some problems can be created for you. Then beyond that, I do hold a position in a gold ETF, and that has also done very well. I have over an average weighted holding period of just over a year, we've made just under 16% for the Granite Shares Gold Trust, which is held in London. But it is also worth noting that that 16% over approximately a year has technically underperformed the S&P 500 still, which is itself is up more like 22% or something like that over the last year, something like that. So gold has done well, but it's underperforming the S&P, at least in the last year. But it's not exactly an asset that I expect to beat the S&P. I like to think of gold, as I said before, more like a competition for treasuries than I think of it as a competition for the S&P 500. I think of gold as money, and I think of gold miners as competition for the S&P 500. So there's that. And if you annualize my returns, as I said, with the weighted average holding period for Silver Corp, I'm actually well over 100% in annualized returns, which of course is because I've held it for such a short period of time. If I hold it for a longer period of time, that'll probably level out at a much more moderate level. And then it's the same thing for New Gold as well. Something to keep in mind when you're looking at those annualized returns is that if you held it for something for a very, very short period of time, then it makes that annualized number look very, very large. It's not like you're actually going to get that annualized return if you do hold it for a whole year. It's probably that your returns were front run in those first few months because you just got the timing really, really good. So that's just something you kind of have to keep in mind. Like, for example, I've held Mastercraft for like a week and a half or something like that. But I'm already up almost 9%. So it says the annualized return is over 1,000%. But it's because it's only been a week and a half. It's not that I'm actually going to get 8 to 9% every week and a half for the next full year, and then suddenly I'm up like an insane amount at the end of it. It's like that's just not how it works. So it's like you kind of have to, when you're looking at the annualized returns, you have to kind of super take into account what your actual position is on that. In fact, if I do have on one of my other sheets, I like to keep track of like what is the annualized return on a weighted average over my whole portfolio of my current holdings. And I think like if you actually take a weighted average based off of both the weighted average of the time and the weighted average of the position sizing, the annualized returns on my current positions is like 16-17% or something like that for my current holdings. Which is good, but the point is you can see how that levels it out if you actually like level things out appropriately. All right, there. Now we're truly done talking about gold. We can maybe talk about a couple other things. It's already been an hour and 40 minutes, so I'm probably not going to stick around for too much longer. But Aryan, if you're still in the chat, I don't know who's still in the chat or not, but maybe we can talk a little bit about InMode and Tesla if you want. I'll maybe start with Tesla a little bit, since like I said, I don't really have a lot to say about it, but I will maybe make a few comments on it. Take a look at the Tesla chart. Tesla is down a bit. I can see why maybe people want me to talk about it. That would maybe be a good reason to consider it. But to be honest, like I said, I haven't really looked at their valuation much in quite some time. But I have slowly but surely been kind of convinced of some pretty negative theses around Tesla. So I'm not very bullish on the industry as a whole, and I'm not very bullish on Tesla specifically within the industry for a variety of reasons. And so that's definitely reasons why like I just haven't come back around to do a DCF on them in quite some time. And I just like feel like it's not a very good use of my time essentially to bother to do so. But I will do like kind of a quick look at some of the stuff right here. Let's narrow in on just the last few years so we can kind of look at these, how the multiples have been behaving recently. Because it is definitely now, as you can see with this decline, we're definitely coming down to at least a semi-reasonable valuation in terms of multiple, depending on what type of growth rates you might expect for them. But yeah, it is what it is. You can't use historical data with Tesla. Well, I mean, I'm not really using historical data with Tesla. When I talk about what my thoughts on Tesla, I'm talking about what I expect for the future of the industry and stuff like that. But my problem with Tesla is on an industry level. I'm pulling up their multiples right here just for a sense of scale, because it's nice to think about like where are they currently at, like what growth rates do you expect from them from their current multiple. I'm not for example, like I would expect them to go back to a higher multiple or anything like that. Definitely don't. I expect this downward trend to likely continue, even if they continue to massively perform on a fundamental basis. But they've come down to like a multiple in like the 50s range. If we come over to like say taking a look at their estimates, what are they currently expecting? Expecting 12 to 13% growth this year, according to 45 analysts. 20-21% next year after that, according to 43 analysts. 14-15%. Or according to 29 analysts after that, which of course analysts can of course be wrong on both ends of things, both to the upside and the downside. And then there's also decent expectations for the margin increase. The next growth phase is for the Cybertruck. We'll definitely have to see about that. Tesla's Cybertruck, I've heard by many, some people argue that it's been a bit of a distraction relative to trying to make further breaks into cheaper the cheaper sedan market for the lower end of the consumer. But at the same time, it could be a good growth path for them if it does end up being very popular. It's just I don't necessarily have a huge amount of opinions on the specific models of Tesla. But okay, so why we'll get into my thoughts on the industry and Tesla in particular. The reason why I'm very hesitant to really be optimistic about the EV space is because I'm well aware that the more EVs become adopted, the more they become a main source of driving for Americans. That means the more the power grid is going to be sapped by the electricity use, and the power grid has already been experiencing some serious problems due to how much it's been taxed by a variety of other reasons. So I don't really believe that a mass level of EV adoption can actually occur in the United States until we upgrade our power grid. I go over this in pretty high detail actually in my advanced auto parts video. So if you want to see like some of the data specifically, where I got the data for why I'm talking about this in this way, basically from what I've read, we would need to basically 5 to 10x our power grid, our total output of the U.S. power grid, in order to make EV become more than 50% of all the vehicles on the road. So I know EVs and Tesla in particular were some of the most popular vehicles sold last year. If you're looking just at the annual sales of cars, it's like, wow, yeah, so many people bought EVs and Teslas last year. I see them on the road all the time, by the way, here in Arizona. I see Teslas everywhere. But to me, it looks more like something that can't be sustainable. It's something that as more and more of them get sold, we're going to have more and more power problems with our power grids. And then at some point or another, people will realize that it's not quite as good of an option for them because of the fact that they won't be able to power them up as much. It will become less reliable. And this, I kind of stumbled into this way of thinking when I was initially trying to look at the growth of the charging stations, because like initially I had heard people say, oh well, the charging stations aren't really coming up to the high levels as much as people expect. But when I was looking into it, it actually looked like the charging stations really were starting to come online at just a fast enough clip as we might need in order for it to soak up the demand for the current EVs. But the problem is that the power grid hasn't changed at all. So it seems to me like we have a serious energy imbalance in terms of the amount of energy people seem to be expecting to be able to make EV adoption happen versus the amount of energy creation that's being made by the power grid itself, which is something that Tesla can't really change. Like that's something that, or EVs in general, they can't really change this. Now, this is not necessarily the case in other countries. So it's possible that plenty of other countries are not going to have this issue. And so maybe there's like large levels of demand there, but like that's definitely something, because obviously Americans aren't the majority of the world or anything like that. But it's something to take into account considering America is one of the strongest consumer economies in the globe. And also has a very large impact on the global culture as well. So like what becomes popular in America often becomes popular around the world in certain places, not necessarily everywhere around the globe. But the point is it has a pretty large impact. So I think that like the way things get perceived by Americans will significantly impact the way it gets perceived by the rest of the world. Hold on a second. Hold on, just one minute. Sorry, I've been talking a while. I needed to cough pretty hard there. So my next concern has to do somewhat with for Tesla in particular. I've been shown a lot of reason to believe like that, for example, the battery costs of the EVs and Teslas in particular makes up like a pretty significant portion of the overall value of the car. And a lot of the Teslas that are on the road currently, more than half of the weighted average of them have been bought in the last few years. And then the batteries themselves tend to last about 5 years. So that means that there's going to be a period of time, maybe not this year, maybe not next year, but like over the next few years, where a significant portion of the older Teslas, the Teslas that were bought a few years prior, and then eventually the ones that were bought in 2020, and then the ones that were bought in 2021, a lot of those Teslas are going to start to need battery replacements. And then those battery replacements are going to, I think, create another major problem. This one more specifically for Tesla, because of the fact that I think that that's going to really, really affect how good of a choice it seems to the consumer to buy a Tesla. Like currently, if you buy a Tesla, you're like, oh well, my gas costs just disappeared, and this is so great because now I'm saving so much money. And then there's also all the subsidies that might have been helping you along the way, though those subsidies have been starting to come down as well. So the point is like Teslas, I think right now seem like a much better option for the consumer than they will in the next few years after enough negative feelings for especially the cheaper lower end customers for Tesla are going to start to feel the pain for the battery replacement costs. That's not going to affect the richer customers, right? Like a lot of those people will be like, yeah, whatever, I'll just buy a new battery. It's not a big problem. But for example, the whole idea about EV mass adoption is by being able to make a sedan that's cheap enough that it's going to replace the median American's vehicle choice. But the median American can't afford to replace their whole vehicle in terms of the cost of the battery in that sense on a regular basis like that. Like the value of the battery itself makes up enough of it that if it was the value taken off in terms of like say an accident, it would be considered totaling the vehicle. So the maintenance costs when you count the battery is going to have a huge impact on just how cheap I think it's perceived by Tesla owners to actually buy and use and own a Tesla. And then that's just thinking about the consumer end of things. There's also the environmental end of things because Teslas are also marketed as being better for the environment because of the fact that you're not burning fossil fuels. But people have often joked and made comments about the fact that that's not entirely true because there is burning of fossil fuels at the power plant end of things. And as we were just saying before, the power plant end of things actually has to go up by a factor of at least 5 in order to service a mass adoption of EVs in the United States. But then that also isn't true at the environmental, the production level for the batteries. The batteries themselves require some significant mining of not the greatest of materials, and those materials have significant impacts on the environmental sustainability of the EVs themselves. So when the batteries start to need to be replaced much more regularly and a much faster clip, I think both the consumer the consumer perception of the value of Tesla is going to plummet very significantly. And then I also think the perception of Teslas as actually being a way to solve sustainability problems is also going to plummet at a very substantial way. Then there's other little details I would point out too, which is, for example, like look at the growth rates that are being implied here. That's a pretty high level of growth rate that you have to be able to sustain after, for example, we saw really, really high growth here in 21 and 2022. And then it came down to a pretty moderate level in 23 and even lower level that is being projected for 24. And then it's expected to bounce back up into the 20s in 25 and 26. That's very possible. That's not necessarily the biggest part of my argument. Like this is probably the easier part for them to work through, assuming, for example, the battery costs haven't started to plummet the value perceptions by that point, because obviously you can point back to, for example, 2019 where they had teen levels and then they bounced back up into like 70s in 2021, right? So obviously you can have a growth bounce back. That's definitely the easier part to deal with. But then there's also the margins to take into account. They've had really, really good margins in 2021 and 2022. And then in 23, the margins came down pretty significantly. Now, I haven't looked super closely to look at exactly the fine details of why that occurred. And it seems like they're pretty moderate in their expectations for where those margins are going to be in this year. But then it looks like the analysts are starting to project that those margins will start to creep back up. Now, I know the general story of why people
argue that Tesla's margins are going to continue to improve and continue to be better than the typical automaker, and that has to do with both perceptions about the manufacturing efficiencies of their plants, and the belief that they're going to just continue to become more and more efficient on the manufacturing level, which is something that I'm a little bit skeptical of just how much that can actually increase things. Like maybe they can say at these kind of like 9 to 10 levels, but the average automaker has margins of like 3 to 6%. So these 9% levels are already significantly better than the average automaker. Now, then the other argument people tend to make about why margins are going to continue to increase for Tesla is, of course, software as a service type arguments. The fact that they're going to be able to sell more things through software and through computer aspects of their systems, not to mention the driving services and stuff like that they potentially end to do. The idea is that people argue that they are not just an auto company; they are also a software company, which is potentially true, but it's something that I think you have to be very careful and skeptical of, especially like given, like I said, some of those other factors and other details. So it's like I'm not very bullish on the EV space in general, and I'm not very bullish on Tesla in particular. Like I said, I haven't done a DCF on them in a couple years at this point. So, I don't really have a super specific number to like point at and be like, oh well, I think it's worth this. This number might be fair value. I don't know. It's possible. But I would be very careful. It's not an industry that I think actually has great tailwinds for it. I actually think it's an industry that is potentially facing lots of headwinds. And I think Tesla in particular is likely to face some serious headwinds. It looks like they have some significant free cash flow growth expectations as well. Looks like they're expected to triple their free cash flow in the next 3 years, which is possible. They basically did that over the previous 3 years. But I don't know. It's a fast clip to increase at. Specifically, if you have even 1 year where this isn't true and then have a negative massive cash flow year, that can bring down your present value pretty significantly. So definitely things to take into account there. And then obviously there's competitive concerns for Tesla as well. People talk a lot about BYD supposedly having better batteries than they do. I don't think BYD's batteries are so good that they're necessarily going to bypass the problems I was saying with the whole battery situation entirely, but maybe it is a little bit better than Tesla's. And then obviously China has subsidized the living hell out of their EV space, which in the short run to the midterm at least can really have a major effect on the perceived success of your space. And the reason why I say that is because I don't think central planning is very good for industrial development in general. I think you end up handicapping technological fields by trying to subsidize them. Like I'm not a big fan, for example, of the CHIP Act either. I think that trying to get the government to pay for the semiconductor plants means that you end up making very inefficient decisions about how, where, and when to do that industrial base. Obviously, there's political and military arguments for why you want to do that stuff anyway, which is totally a lot more understandable in my perspective. But then at that point, you're sacrificing efficiency for safety under those circumstances. Now, in the EV space, it's not exactly the those type of issues with it, but I do think that subsidization in the long run is not very good for the competitiveness of an industry. So China, I do think, might be able to pump out massive EVs, and that might massively hurt Tesla in particular in the mid to short term. But in the more of a longer term sense, it definitely, I think, might hurt China on that regard as well. But the point is it could cause such a flooding of total EVs out in the space that it could make the overall profitability of the entire sector come down pretty dramatically and make it very hard for people to have a sustainable higher profit margin because of the fact that they'll have to undercut their prices in order to compete at such a high level. So that's all my thoughts on Tesla. Like I said, I said it kind of at the start, I definitely had lots of negative things to say both on the EV space and on Tesla in particular. But like I said, I haven't also done an actual DCF on them in like 2 years. So I don't really have like a super specific number to point out and be like, oh yeah, I think they're very overvalued or anything like that. I just think it's probably likely that they're going to face lots of headwinds. And so even if they were fair value today, I could see the sentiment going against them pretty hard in the next 2 or 3 years. At which point you better be damn sure about that valuation. And well, I said, like, it's possible that they're fair value where they are today. I actually don't think that's likely, though. I do think it's definitely much more likely that they're significantly overvalued. But that maybe that they're just being kept the front running of the returns essentially. Now you did ask there right at the end how my job hunt is going. I did make some comments on that a little bit earlier. My job hunt has been going pretty well. I do think I've potentially lock down some pretty good opportunities for that. But there is still some potential questions about that. It's not 100% on my most preferred jobs situation, but I do think that I potentially will be 100% locked down very, very soon. So I'm still trying to kind of pay attention and keep things open just in case the one really, really good option that I have in front of me falls through. I am trying to essentially keep a few potential other options in the wings just in case that one falls through. But it's very, very possible that my job hunt will be over very, very soon, which is really, really great news. It's been a very difficult and challenging and stressful situation to deal with, and also it led to lots of other uncertainties for me as well, considering I was applying in lots of states around the U.S., which meant that it was very possible I was going to have to move very to a moderate or a significant degree in order to go to wherever my new career was. And some of my newer opportunities are much closer to where I currently am. So that potential, that need for me to maybe have to move is potentially off the table as well, which is a pretty significant relief. I was, like I said, more than willing to move, but it creates lots of headaches. I've moved across the country before, and then I moved back. And so I've done that kind of process twice, and it's both stressful and costly. And coming right out of college into my new career, it would be kind of nice to just not have that headache. So that's one thing I'm definitely very, very hopeful of, is not having to move state in order to do that. So that might be it for today. I know you also asked about InMode, but I don't know. I have lots of things I could say about InMode that would almost be like its whole other discussion. What I would say is, like, I know you're in the Discord, Ariane. I know you don't necessarily do a lot in there, but we did have a pretty vibrant discussion on InMode all like a week or two ago. So I would maybe like use the search function to try to find that conversation, because honestly I went into some pretty high details both on my thoughts around it, but also essentially trying to combat a lot of the negativity and the criticisms around the management's decisions recently in that regard. So what I would say is maybe go take a look at some of that stuff, because we are here pretty much at the 2 hour mark. Maybe I'll go for that one, maybe the next live stream if you still have questions about it. But yeah, so I would say maybe that's going to be pretty much it for today. Come back over here. Let me see if there's any last things I wanted to say. As I kind of had said a few times earlier in the stream, I'm potentially going to be working on a Mastercraft video. I'm definitely gonna be working on a Mastercraft model, but whether or not it gets made into a video kind of depends on how I feel about the model once I'm done with it. So, but that's a company I'm working on in the short run. I did take a position in that over the last 2 weeks. It's 1% of my portfolio. So we'll see how the Mastercraft model comes out. We'll see if maybe I end up making a video out of it. But I also had commented on 2 other videos I've been working on kind of in the background, which is not really valuation videos, or kind of like other stuff. One is that I've been redoing my sector pricing analysis that I did a few months back. I'm repeating that process, and my goal is to potentially do that essentially every quarter after the last of my companies reports their earnings, which in my current portfolio's case is Smith & Wesson. So you can kind of keep that in mind. They're the one that reports latest, and that'll give you an idea of when I would be working on that next. But essentially, whenever that's done, I would be redoing the pricing analysis for the overall sector to try to use it both as a sifting device to try to identify opportunities to look for good valuations within, because I felt like the last time I did that, I feel like I ended up actually finding some decent opportunities that way. So I kind of wanted to repeat the process. It felt like the juice was worth the squeeze on the process. It's a lot of work to do the pricing analysis, but it also felt like it got me some solid results. But not only is it because I think it's a good sifting method, but I think the reason why it gives good results is because it is different from valuation. It's just looking at fundamentals and the current multiples, and looking at them from like a statistical perspective rather than just as like a cash flow DCF sort of perspective. So I actually do think of it as not the same as valuation. That's why I like to refer to it as pricing rather than relative valuation, which is another term people often use to refer to kind of the same thing. It's like I don't like the term relative valuation or comparable valuation. I prefer pricing or comparable pricing, or you can even say relative pricing, but I like to use the word pricing rather than value, because I do think it is a different thing altogether. And I got this dichotomy from Aswat the Motoron. This is something he likes to do, but it's true that a lot of other academics and plenty of analysts and investment managers just use the term relative valuation for effectively the same concept. But the point is, I'm redoing that because I do think it's essentially different. It adds almost like a little bit of an extra icing on the cake to a normal DCF, where if you have the DCF in your favor and you like the industry and you like the management and you like the macro dynamics, then you have that in your favor. And then if you have the pricing working in your favor, well, then to me, that's like another thing that's working in your favor that can make it so that the fair value could get recognized sooner rather than later. And then, I mean, there's other factors to keep in mind, like what does the analyst think, and then there's like technical details to take into account as well. But point is it's nice to have lots of things working in your favor, not just the DCF number that you came up with, because I do believe that DCF valuation is, the real essence of the actual value of the company. I think that that actually represents what a company really truly is worth. But as John Maynard Keynes likes to say, the market can remain irrational longer than you could remain solvent. So it's nice to have more than just one element of rationality working in your favor, because the markets are pretty irrational sometimes. Go back to, for example, my comments earlier about SMCI, where it's possible I was very wrong in my video of the specific value I gave, because like when it was trading at like $80 to $90, I said that I thought it was worth like $70 or $80 or something like that. I thought it was a bit overvalued, but not crazy overvalued. And then it 10x from there. Now it's almost for sure that it doesn't actually deserve this 10x, but it's possible I was still wrong to a significant degree. Maybe it's worth $100 to $200. Maybe it's worth $300. You know, I would bet more like $150 or something like that if I had to guess. Because I do think it's absurdly overvalued. But the point is here's the market being very irrational. So the point is if I had gone and say chosen to short this company because I saw it as, oh, it's more than twice my fair value when it's at 300. Imagine you had shorted it at that point in time, right? So one of those things in time that, like, yeah, markets can be irrational longer than you can remain solvent. So yeah, I think pricing is just one extra detail that kind of helps with that. So anyway, like I said, I'm making a video redoing the sector pricings, and then I'm also making a video in the somewhat near term going over my record of companies, including SMCI as being a company that I would say I made a significant mistake or a failure in. I don't know, I would say it's a mistake not to have invested in it, because like I said, I think it's more speculative than anything else, the run up that it's had. But the point is, you can make the argument that the call I made was still wrong to a significant degree. But we're going to go over my winners and my losers in terms of the videos I created, not just in terms of my portfolio. So I'm planning to do a video at some point in the near future going over the record of my videos, specifically all the companies that I did here. What was the value I said it was worth in the video? What do I think the value is worth now? What was the highs and the lows since the video came out? And then also, what actions have I personally taken in regards to stock? Have I bought it? Have I sold it? Was I already holding it? Am I still holding it? Things like that. And we're going to do that for all of the valuation videos that I've put out since I came up with the DCF template that has the valuation distributions. So that's what you guys can expect from me in the short to midterm. Like I said, I hope to put out at least one of those videos relatively soon, but that's kind of like 3 video ideas that are kind of working in the near future. Hopefully we'll do another live show in another 2 weeks. That's kind of like the pace I'm trying to at least keep at for now. So if you've watched up to this point and you really like the content I put out, we'd really appreciate it if you would give us a like. Subscribe to the channel if you haven't already. Join the free Discord. Link is in the description below. And if you're interested in also supporting the channel, there is also the PayPal link, which you can find both on the main page in the description below, as well as the Patreon. You can join for $3 a month just to support me, or you could go for $5 a month in order to get access to the valuation dashboard, which there's only 2 members currently, though there's also technically a third member that has more of the alpha version of it. But the point is yeah, if you guys would like to support me, there are multiple ways you can do so. All right, I'll catch you all in the next live stream or the next valuation video, whichever comes first. All right, bye.